All right, I'm Michael Hartzman. Today is Tuesday, August 26th, 2025, and I'm back after a 2 week layoff. I appreciate Tracy Byrnes sitting in my absence. How are you, Dom?
Doing well, and welcome back, Mike. Happy to have you back with us.
Thank you. Thank you. So last week, while you were doing the podcast, I was literally sitting on a New Jersey turnpike, not moving because you can't make this up, an ice cream truck incinerated on the New Jersey Turnpike. The whole truck melted. I'm not exaggerating. No one got hurt. That's why we can laugh about it. And we just sat there dumb. I probably could have done the show because I was sitting in my car doing nothing.
Well, we're grateful that we have Tracy that can step in both for myself and you at a short notice, and she's obviously very qualified with her background. But like I said, Mike, happy to have you back and in your usual chair, your usual role. And man, let's talk about what happened last week.
Yeah, let's talk about it. Every day the market continues the 3 day losing streak, the 4 day losing streak. Let's see what, Powell says at Jackson Hole. And whatever he said, the market had a resounding response to it, didn't it?
I had our normal advisor call this morning, and I said, "You really look at last week. It's a two-part story. The first, basically, 4 days of the week, which markets kind of worried about what he was going to say, and the general rumor out there was that Powell was going to be kind of negative and kind of strong-willed about his interest rate policy. And so you had the Nasdaq down 3.5%, the Dow what 2%, the S&P about 2.5% through the first 4 days, and it looked like if Powell put the comma in the wrong spot or said the wrong word, we could easily pull down another 3-5%. And lo and behold, Mike, he came off kind of dovish and implying that he was going to at least consider cutting interest rates in September. And wow, the market took off.
Yeah, and as a result, the S&P was up a third of a percent for the week. The Dow was up 1.5%, a little bit more, and the Nasdaq was only down 0.5%. But quarter to date, they're all firmly in the black, and year to date, they are significantly in the black still, happily. Year to date, the S&P is up almost 11, the Dow is up almost to 8.5, and the Nasdaq is up almost 12, 11.8, and that's as of Friday night's close,
Yeah,
August
Mike,
23rd.
I know we say this often, but if you kind of went to sleep the previous Friday and you woke up this Friday, you go, it's kind of a quiet week. The major indices didn't really move up or down very much, and yet, boy, the difference between Thursday night's close and Friday night's close was quite extraordinary. And I do think the volatility continues here until the next Fed meeting in September. But boy, it was a little bit of a relief rally. That's what I would call it.
I did jump on the broker call for the last 15 minutes, and you didn't obviously want to look at that your Zoom screen because you didn't see me, and you were doing such a good job. I didn't say anything, but I heard you for the last 15 minutes, and you said something which resonated, and it's true. The market goes up 800 points because the Feds made lower interest rates 25 basis points. 25 now, and you said it this morning, and I'm going to say it now. I'm going to steal your thunder. How does that move the needle economically? It just doesn't.
It doesn't, Mike, and I'm glad you brought it up, and I'm glad you were listening. And I wish you would have jumped in. I always appreciate your 2 cents in these conversations. The reality, I think, is, and I brought up this morning, so I apologize if you're hearing it again, that the quarter, or maybe I don't think it's going to be 0.5%, but the 1/4% cut in itself is likely not to even touch the needle. Forget about move the needle, right? But if it starts the process where the following meeting they do 1/4%, and the following meeting they do maybe 0.5%, then this cycle of lowering interest rates over the next 3 to 6 months would be positive for the economy. So if you're looking at it at a longer term basis, this is a positive. In the short term, I don't think it does anything to change this cyclicality of where we are right now in the economy?
I think what it does change, and maybe our guest this evening could have an opinion on this as well, who teaches economics at NYU. I think what it does change, Dominic, is the psychology, right? I mean, how much ink is spilled on behavioral finance? And I think the psychology of finally getting lower rates, of not having the president complain about it constantly, and the tide turning is more important than what he actually does, whether it's a quarter or a half. Because I think if he did a half, that'd be bad. I think that would send the wrong message.
Yeah, Mike, one of the guests, I know one of your favorites, Jeff, who was with us, I think last week,
Uh,
uh, talks about small business confidence and how important the small business community is to the economic growth in this country, how important the small business community is to hiring and new job creation in this country. And he basically described a community out there that was frozen because of uncertainty. So, to your point about the psychology of where we are, I think if the small business community particularly can just take a sigh of relief and go, we're going to have a lower interest rate environment and our borrowing costs are going to be a little bit lower. Our ability to pay down our debt is going to be a little bit better. That can go a long way for economic growth and job creation.
yeah, absolutely. And then, we was also talked about this morning when I was listening in, was the whole idea that for the and you're Dom, this is one of your favorite subjects, and I know it's important to you when you talk about people who struggle economically every week. What difference does it make if the credit card rate is 29.8 or 29.5, right? So there's no real benefit to them other than I also think psychologically they could feel that relief might be around the corner somehow.
Look, it is one of my topics that I don't want to call it favorite topics, but kind of remind people, not only our own clients, but our listeners, viewers, that there's a considerable part of this population that struggles week to week, right? I saw one of those interesting stats that if you have $100 in your wallet and no debt, you basically are better than 25% of the people in this country. So there's a lot of people in this country that are hurting, struggling to buy groceries, pay their bills, pay their rent on time. And the inflation implications have been brutal to that group. And again, we're not here to tout some of the things that have happened in the past, either good or bad. But there are real implications to these inflationary stories and the ability for people to even simply put food on the table. So, we are talking about a higher level and higher net worth kind of client base, especially in our practices, but we need to be sensitive to other people in this country.
That is a perfect segue to tonight's guest and the meat of the show. So we've been waiting for Howard Yaris, now hopefully I said his name correctly, to be on our show once we knew his book was coming out, and he asked us to wait for the book to actually come out, which it did August 5th. So Howard is a professor at NYU, and he wrote a book called Understandable Economics, because understanding our economy is easier than you think and more important than you know. And the only thing that I'm frustrated about is why didn't you and I think of writing this book?
And I'm sure we're going to get into a lot of, hopefully, a little chuckles here and there with Howard, but economists in general, because their forecasting usually is challenging.
Yeah,
Um, am I being politically correct here, Mike?
yeah.
They don't always have the best reputation, but I do think if you apply a little common sense to economics, then it actually does make sense. So I'm very much looking forward to this conversation tonight.
Yeah, look, and some of his bullet points that he sent us are things that you and I have been talking about forever. Who pays for tariffs and how do they affect prices, jobs, and our economy? Are government's huge deficits and escalating national debt threats to our well being? What causes inflation? How big a problem is it? And how can we rein it in? Those are just a few examples of the things that he's covered. And they're really important topics. And as I said to Howard before the show, we may not be buying two of his books. We may be buying dozens of his books so we could give to our clients.
Well, let's look forward to some really good common sense answers.
So we will be right back with Howard Yaris, the author of Understandable Economics, because understanding our economy is easier than you think and more important than you know. All right, I'm Michael Hartzman, back as always with my partner Dominick Tavella and our special guest this evening, Howard Yaris, a professor at New York University in Manhattan, one of the best schools in the country, and the recent author of Understandable Economics, because this is my favorite part, because understanding our economy is easier than you think and more important than you know. I love that, Howard.
Thanks.
So let's just start right there. Was that the genesis of why you wrote the book?
Well, the genesis started back in Sheepshead Bay, where Michael and I grew up. I worked in my father's grocery store, and he was employed a bunch of people who were over 70 years old because their Social Security was not adequate for them to get by on. He also hired a lot of young people who were sort of clearly going into dead-end careers. And I looked at this and I just thought there's such a radical difference in where people are going in life, what kinds of opportunities they have, what kind of resources that they can access. And I became fascinated by it. And that's what led me to have an interest in economics. And so I took obviously a lot of courses in economics. And the one thing that always interested me is how poorly it's taught. I know you and I went to Sheepshead High School. We didn't have to take a course in economics. I thought it was an incredible irony that more high school students take a course in trigonometry than they do in economics or finance. Doesn't make much sense to me. So a lot of people.
I use my trigonometry skills daily, Howard.
I'm sure you do. So again, trigonometry is there, economics is not. So most people don't wind up taking a course in economics. And the people who do take a course in economics, usually you take it in college, and the professor makes all sorts of assumptions, puts formulas on the board, graphs, charts, jargon, all sorts of technical language. And in my humble opinion, I don't think the students have a better understanding of what's going on in the real world than they had before they took the course. Math is important if you're trying to tease out relationships with precision. But if you're just trying to understand the basic relationships, you don't need high-level math or formulas. I actually think formulas can interfere with understanding. You just need some basic foundational knowledge and a good look at the world and some common sense, and you could figure it out. So that's the gestation of the book. I'll just add that economics is so important. If for people who say, well, we'll leave it to the experts, we'll leave it to the economists, they may very well get policies they don't like. Economics affects everyone's life, what you do, what you get. And if you just cede those very important decisions to the quote unquote experts, again, you may not get what you like.
So Howard, I can't help. It's not really the question I wanted to ask, but I kind of put myself through college waiting on tables, and the best economic lesson I ever learned, and I took economics in college, was that if I worked really hard, took care of my clients, they left me bigger tips. So I'm wondering if the job you had in your family business taught you more than what you learned in college.
I think it made me curious about what was going on. I don't know how much I learned. Obviously, supply and demand. My father's store wasn't exactly a gold mine, so I learned a bit about that. But I think it got me very interested in how economics works, why there's such a difference in outcomes, in opportunities, in resources, and so it really just spurred an interest more than anything.
So Dominic, why don't you ask the actual question you had on your
Yeah,
mind?
I was a little humor there, although I do say that was the best course I ever took in my life. But the first one on your list, and we get this from clients all the time. It's obviously a political football, but Social Security is going to run out of money. I'm not going to have any money. I'm not going to get a paycheck from the government, Social Security check from the government. Are we really ever going to run out of money in the Social Security fund?
I find it so interesting that people worry about Social Security going bankrupt, but they don't worry about the Pentagon going bankrupt or the State Department going bankrupt or any other division of the federal government or program of the federal government. Programs are solvent if Congress allocates the money. Programs are not solvent if Congress doesn't allocate the money. It's that simple. If Congress allocates the money needed to pay the Social Security benefits, it's fine. If they don't, it's not fine. Social Security, I understand, is a bit unique because there's a dedicated tax to it, the FICA tax. But that said, it's just a government program like the Pentagon. And the question is whether the government funds it or not. It's that simple. The fact that they've identified this particular stream of tax revenue that they allocate to Social Security doesn't really affect anything. It's not like your personal budget. It's a government program like any other program. So the question is, do they have the political interest in funding it or not funding it? And so again, it's not an economic question. It's a purely political question.
And if I could just follow up real quick, Mike, would any political party, we're not going to get into one or the other right now, would any political party raise their hand and go, we're going to lower somebody's Social Security check?
Well, the way that the legislation currently works, if the Social Security Trust Fund runs out, right now there's a surplus in there. There's a good amount of money in there. But sometime in the 2030s, that trust fund, those segregated funds will run out, and the Social Security program, like the Pentagon, will need an allocation from Congress. And if Congress doesn't make that allocation, benefits will be cut. So they may make some argument that somehow this is, I cannot anticipate the argument that'll be made. There are a lot of arguments that politicians made that are very misleading, and they may make some kind of argument that this is something they can't affect or they can't influence. In any event, the bottom line is there's a certain funding for it. If Congress funds it, it's fine. If Congress doesn't fund it, it's not fine. It's a lot of money, unequivocally. And it may make sense to increase the taxes allocated to Social Security, or maybe consider limiting the benefits in some way. But again, it's a purely political decision. Has nothing to do with economics.
I could personally see them pushing the age up again from 67 to 70. But, I always like to say, people in red hats, blue hats, and purple hats all want their Social Security.
Yes, there's a great constituency for it, and that constituency votes. And it's not just people over 65, it's people approaching 65. So there's a strong constituency for that, which is further proof that it's really a political issue. So no, my guess is, despite all the rhetoric, people have tried to take a whack at Social Security a bunch of times in history. It seems pretty durable. So my guess is when push comes to shove, they'll make some cuts around the edges, and the program will be adequately funded.
So another bullet point you have is about inflation. And you heard Dominic and I talk about interest rates in the open. And especially now, unfortunately, the Federal Reserve has become a political entity, which I think is not good at all. But sticking to your bullet point, let's talk about inflation. The way you describe it is what causes inflation, how big a problem is it, and how can we rein it in? So other than the discussion Dominic and I had on interest rates, how would you how would you address that issue, Howard?
Well, just for the benefit of some of your listeners may not be as knowledgeable about inflation as you are. So I'll just define inflation and then explain in 2 words. How's that? What
Perfect.
causes inflation? I always love short explanations. Inflation is just an increase in prices. What causes it? It's the relationship between spending and stuff. That's it. I always impress upon the class those 2 words. If spending is increasing faster than the stuff, you get inflation. If spending increases at the same rate as the stuff, and by stuff I mean goods and services, you get stable prices, and rarely spending can increase or actually decrease. If spending is going up less fast than the amount of stuff being put out into the economy, you get lower prices. So that's what inflation is, and that is what causes inflation. You talked about a 0.25% decrease in the federal funds rate. Paradoxically, as I was listening to you say that, I was thinking that may actually cause an increase in inflation. I'll tell you why. The producer price index last month went up 0.9%. That's almost 1% in 1 month. What is the producer price index? It's the cost of wholesale goods. The cost of wholesale goods has there's a lag, but has a direct effect on retail goods. 1% in 1 month, that's huge. So to the extent that interest rates are cut, as you, Michael, pointed out, 1/4 of 1%, what's that going to do to people's decisions, whether to borrow or not? Probably not much. But if it causes people to think, hey, the Fed is not as vigilant about inflation anymore, I think paradoxically, if they seem docile to Trump, or they don't seem to have their hands firmly on the steering wheel, that cutting interest rates in an environment where prices are going up can cause people to lose confidence in the Fed's resolve to keep inflation under wrap. And that's when you're off to the races.
And we actually had a little bit of that last year, didn't we, Howard? The Fed last year lowered interest rates on the short end. I think it was 4 times.
Right.
Longer term interest rates actually went higher because investors are like, wait a minute, inflation here might get a little bit out of control, and I want to get paid for long-term bonds, on long-term interest on long-term bonds.
Yeah, I'm not a psychologist, but Donald Trump was a real estate developer. His whole life was seeking out lower interest rates. That's the holy grail for a real estate developer, which is great if you're a real estate developer. It's terrible if the economy is overheating. So it'll be interesting to see how that plays out.
Something just popped into my head, which I'm going to ask, because you teach in New York City, you teach in the real estate school, and this is going to be off topic a little bit, but not so much. What's your opinion of the mayoral race, and if the Democratic candidate gets elected, which it appears he might, the real estate apocalypse in New York City and the 5 boroughs is already being predicted. So is that overblown? I mean, and if you don't want to answer it, that's fine. But do you have a take on what's happening in New York City right now, since you live there?
I'll be happy to address that. Let me say, first and most importantly, I really try as hard as possible to be nonpartisan in the book. I make the point that the way to assess an idea is not to think of where the idea comes from. Does it come from the left? Does it come from the right? It's whether the idea is a good idea. It doesn't matter where it comes from. So in the book, I try to be non-political. This is not the book now. The mayor's race, I will go out on a limb and say if you chose 3 people at random on New York City streets, you might have 3 better candidates than the 3 frontrunners for the New York City mayor at this point. Mamdani is is the likely winner of this race. And I think what would happen if he gets elected is a very significant part of New York City's budget comes from the federal government. And I think Donald Trump would be likely to significantly reduce those funds. So I think his time and his efforts would be monopolized by trying to stem the harm that results from those cuts. That's how I think it would play out. I don't think he's going to be spending his time opening up 5 grocery stores to compete with someone like my father, whose store is no longer there. I think that's a colossal diversion. But I do think that New York City is in for a tough patch if he gets elected, because my expectation is Donald Trump would really close the faucet of federal funds, which, again, the city heavily relies on. And that would be, I think the city would have a very hard time figuring out how to deal with that. I don't know if that answers your question.
It does.
So Howard, I think this is basic economics. We've seen a considerable number of people leave the New York tri-state region for lower tax states. And ironically, it's not the poor that leave. They don't have the money to do it. It's the wealthy, and they take their tax revenue with them. So from purely economic perspective, do you really want to kick out or incentivize the high net worth, the taxpayers in the state to leave?
Absolutely not. I make a big point in my book about how reliant New York City is on the tax revenue from the highest 1% of earners. If they didn't have the highest 1% of earners, the budget would be half. So it's critical that New York City keep wealthy people here. But I'll say something that's often not understood. I think a lot of people think of wealthy people moving. They don't have to move. All they have to do is file a form to redeclare their domicile to Florida. That's what Donald Trump did. He just filed a form. He didn't move. He just filed a form. And if you stay out of New York City for half the year, you are no longer subject to New York City taxation. So all they would have to do is file the form to redomicile themselves. Frankly, I'll tell you a story from my personal experience. The company rating group, the debt guarantor that I worked for 10 years, was domiciled, headquartered in Philadelphia. I spent a lot of time in Philadelphia. I had to choose which state to pay taxes in, Pennsylvania or New York. Wealthy people have a lot of choices, and the truly wealthy have a lot of homes. And so there's some discretion. They don't have to pick up and move, get a new lease for a new apartment somewhere else. They can just reorient their affairs. Not all, but a good percentage of them can reorient their affairs so that New York State and New York City are no longer their primary domicile where they pay taxes. So it is easier than picking up and moving. Again, it's not the easiest thing in the world, but it is. A lot of times people talk about picking up and moving. It's actually a lot easier than that. And so the bottom line is a lot of New York City's tax revenue is on the line with that.
So to that point, and this is, again, a perfect segue, your book covers inequality. And you asked the question, why is inequality soaring, and what can we do about it? I would argue that as a result of inequality, someone like Mamdani is the front runner now. Wouldn't you agree?
I think he offers a few things like free buses and free childcare that a lot of people seem to like. He has as much ability to deliver those as Trump had the ability to deliver the end to the Ukraine war on the first day in office. I just want to go back to why I wrote the book. I think a lot of people are passive. They're letting decisions be made in their name that they may not like. People need to get more involved. When they hear things that are just pie in the sky and not realistic, and they have to be involved, they need to vote accordingly. And if they don't, they're going to wind up with a government and with policies that are really, they don't like and that are really not good. So people need to be more proactive. You're not electing someone you want to have a beer with. You're electing someone to perform a very important role in the economy and in your life. So you need to take it seriously, those decisions seriously. And that's really the whole point of the book. It's enabling people to be more proactive with regard to that very important role in our democracy.
So bigger picture, the question you ask, why is inequality soaring? I'll ask you, why is inequality soaring?
At the risk of being a one-word answer, which is somewhat misleading, but I will expand on it. The internet. Back in the 1950s, if you ran a store in New York and wanted to run a store in California or Jakarta, that was really difficult and really inexpensive. Now Jeff Bezos could sell retail stuff throughout the world on the cost-free platform of the internet. Basically, what it's allowed is monopolizing. Jeff Bezos through Amazon is monopolizing retail. Uber monopolizes taxi services. Google monopolizes search services. Technology has enabled more concentration of business. There's less opportunity. One of the points I make in the book is 100 years ago, every city had music halls. People made money singing and collecting tickets and ushering people to their seats. Now, there are a few great international celebrity singers that make $1 gazillion a year, but there are only a few of them, and there's much less of a role for each of those jobs. I also make the point in the book furniture. Furniture was made locally. Now it's there are a few mass producers of furniture. Things are becoming more and more concentrated. And when things become more and more, business becomes more and more concentrated, they have more monopoly power, more pricing power, more power of their employees, more power of their suppliers. And I think that it's what people call it the winner take all economy. And maybe it's not the winner take all, but it's the winner take most. And that's what we've moved to, not because of any evil intent, but because technology has just enabled economies of scale that in the past were impossible.
You know what? Let's take a break here. And when we come back, I want to ask you about what do they call it, Dominic? The gig economy or the gig economy, the digital economy, the Uber drivers, the Amazon delivery guys, how that has affected the economy as well. Because these companies you mentioned, they've created tens of thousands of jobs at the same time. They just might not be great jobs.
Mm-hmm.
And destroyed tens of thousands of
Yeah,
jobs.
absolutely. So let's take a break right now, and we will be back with Howard Yaris, the author of Understandable Economics. We'll take a quick break, and we'll be right back with Howard. All right, I'm Michael Hartzman, back with Dominick and our guest this evening, Howard Yaris, the author of Understandable Economics, because understanding our economy is easier than you think and more important than you know. Howard, I mentioned it just before the break. The economy is changing rapidly. It doesn't look anything like it did 20, 30 years ago. A big part of that is the gig economy, which I think ties into the last topic about the inequality of the economy. Dominick and I spent a lot of time with financial institutions and thought leaders at some of the largest financial investment companies in the world. And they rave about the gig economy because of the freedom, the independence, the entrepreneurship, the flexibility of being an Uber driver, Uber Eats, Amazon, whatever you could think of. But at the same token, I think you might argue that's also created a bit to the inequality because these jobs may offer those things, but they ain't great jobs.
Well, freedom is great if you have some leverage. And I think what we were discussing before, Michael, is that there's so much more concentration now in business. Amazon has so much more market power than any retailer ever had. Uh, they're, they're just so much more concentrated on the power among some of the larger businesses that, yes, independent contracting is gives a person a lot of freedom. But if you're up against a monolith that holds all the cards, you really don't have that much freedom. So I think the gig economy has definitely positive aspects, but given that it's just a few players that control the terms for all those tens of thousands, if not hundreds of thousands of gig workers, there's an imbalance of negotiating power there. And a lot of them don't feel like they're enjoying all this freedom. They feel that they must adhere to whatever terms these enormous behemoth companies dictate to them.
And so net, Howard, I know this is kind of a tough call, but we do expect a different economy 20 years from now than what it looks like today. And we talk about artificial intelligence and taking over certain jobs and responsibilities. But the lower end employee, the lower end consumer, are they in trouble?
Yes, in a word. But I'll say this: there is and will always be a need for people involved in personal service industries, healthcare, cutting hair. There are just certain industries that you just can't have AI do it or automation do it or outsource it. And there are a lot of those industries. And here's the interesting thing. Most people think, oh, they're nostalgic about the manufacturing age when people could have a job on an assembly line and earn a good income. Well, there's no reason you can't earn a good income in a service job. It's just that the manufacturing jobs were unionized for better or for worse. And so they were able to have the leverage against the big employers to get higher wages. Service workers are not unionized, and those jobs could theoretically be as good as the manufacturing jobs if there was a better balance of power. I think this nostalgia from manufacturing jobs is kind of silly. It's like having nostalgia for tilling the soil. I think it's a great achievement. Technology has offered us a great achievement that people don't have to live on a farm tilling a soil. At the time of the revolution, 99% of Americans were working on farms. It's great that only 1% work on farms now. I think it's great that people have more options than toiling away in a factory. I know Secretary Lutnick said he was nostalgic for having millions of jobs where you tighten a little screw and whatever. Who wants that? I think it's great if people had more opportunity and better jobs. And so I think one of the main problems for people who are lower on the skill level is just that the big companies exert so much power. It's very hard for them to enjoy the freedoms they theoretically have as gig workers.
So that's another great segue for one of your other points, and it's the first one that I have on my list is about tariffs. One of the arguments, in addition to creating more revenue, is bringing jobs back to America. So the way you describe it is who pays for tariffs? How do they affect prices, jobs, and our economy? So, you know, that's been all the news since the beginning of April. And to your point, the economy seems to have survived the blow because we are basically a service economy. So, what is your take on tariffs and how it's affecting our economy?
Well, there's a lot going on here. First, what are tariffs? For those listeners who don't know what they are, they're a tax on imports. That's it. It's like a sales tax on imports. And what happens when you tax something? The consumer pays more. The thought that foreign companies are quote unquote eating in tariffs is for naught, because there's statistics, excellent statistics on how much importers are paying for goods, and goods foreigners have not reduced the price of imports. Again, they have to report that because that's the price upon which the tariff tax is imposed. And so those prices are not going down. So ultimately, it's American consumers paying those taxes, increasing what American consumers are paying for imports. But the analysis doesn't stop there. What happens to the domestic producer when they see their foreign competitors' price going up? They say, hey, we'll raise our price as well. If the French wine goes up 15%, the California winery says, well, we could raise our price by 8% and still be competitive. We used to have the same price. Their price went up by 15%. We'll raise our price by 8%, and we're still competitive. So it raises all prices. And that's the problem with tariffs. It just makes things more expensive, reduces consumer spending, and slows the economy.
So we look at the consumer spending numbers, and again, we're seeing this dichotomy where the higher end consumer still seems to have money, they seem to be spending, but the lower end consumer is really bumping their head now on the ceiling. They've kind of run out of runway here in their ability to spend more. When do we start seeing the economic effect of that?
I left out the most important point: lags. It takes a while for it to filter through. It takes a while for the goods to be imported to the United States. Right now, a lot of the imported goods sold are goods that came months ago to the United States and sat in US warehouses, goods that came before the tariffs were imposed. As those inventories wind down, as those warehouses empty out, new goods come in, and those are subject to the tariffs. And that's when the increase in prices get filtered through to the consumer. Again, I mentioned a while ago about the 0.9% increase in the producer price index. I think you're going to start seeing the tariffs having an effect on consumer prices. I'll just make one further point. The lags are particularly lagging in this case because a lot of industries saw the tariffs on the horizon and bulked up their inventories, bulked up their warehouses in a rush to get goods before the tariffs kicked in. So it's taking a while for those inventories and those warehouses to whittle down, but they're whittling down. And that's when it's a question of when and not if. And that's when you'll start seeing the increase in prices.
Howard, economics is basically the gathering of data and making forecasts, correct?
Well, John Kenneth Galbraith had the famous line, economists make predictions not because they can, but because they're asked. So there's, yes, the goal of economics is to make predictions, but just let's be honest here. It's very hard to predict. This is a bit of a diversion. I always ask people, what is the word for a human being who is overcome by a malaise, can't get out of bed, can't go to work, can't have a relationship? What's the psychiatrist's word for that individual? What are they in?
A depression.
Exactly. And there's this reason why the economic term for a downturn is the same. You can check the industrial capacity right before the Great Depression and right after the Great Depression in 1929 and 1930. The factories didn't change. You can do a skills test on every worker in 1929 and 1931, and their skills hadn't changed. What changed? It's a psychological phenomenon. Their outlook changed, and everything turned down. So that's the point I wanted to make about psychology. And so to say to a psychiatrist, well, put some numbers into a formula, put some data into a formula, and see what's going to get this person up out of bed and be productive member of society again. Again, it's not it's data is helpful, but it's for people. I think a lot of people are intimidated by the data. Data is useful to reaching conclusions about that, but I think using some good common sense could also get you a lot of insight.
So I'm glad you said that, because my question was, and I apologize, Dominic. The question really was about the data, right? The data has to be trusted, right? It doesn't have to be correct, but it has to be trusted. It has to be that you haven't cooked the books. So do you get nervous as an economist when the messenger of the data gets sent out to pasture and gets shot because they don't like the data? Is that a problem for the economy and for economists in general?
No question. It's not only a problem for economists, it's a problem for people like you who do investments. If you don't have good data, you can't make good decisions. Everyone relies on data. Data is important to economics. It's incredibly important to finance. And to the extent that even if the person they bring in is completely legitimate and completely nonpartisan, a lot of their credibility has been blown because there was no allegation, no specific allegation as to how the person who was fired at the Bureau of Labor Statistics cooked the books. They just said she cooked the books and she's out. So without credible, specific allegations, it just undermines.
But Howard, I'm going to interrupt you on purpose on this one, right? Because I'd love your 2 cents on the story. And this is not a political call, because it happened during the Biden administration where we magically lost 800,000 jobs, and now we've seen it under this administration. So how can, in today's day and age of technology and sophistication and media and the internet, how can they be this far off? Not a political question. Not a political. It happened under both administrations.
It's the opposite of a political question. Statistically, how can that happen? Very simply, they are required by law to give monthly data. And when things are changing pretty rapidly, they have to extrapolate a lot in the data they provide, because things are changing rapidly and their data sets are far from perfect. And in fact, there have been a lot of cuts to their budget, making them even less perfect. So what they do is they extrapolate. So when the economy is really starts to enter a down phase or a phase, that extrapolation causes a greater error. If things are going along smoothly in a flat way, their extrapolation works fine. But when the jobs start to fall off a cliff, or jobs start to have a great resurgence of jobs, that extrapolation leads to very data that needs to be corrected. And that is what they claim happened last month. And I have, again, not seen evidence that that's not correct.
Dom, I'm not saying anything. I assume you have a follow-up to that, so I'm just not going to say anything.
Look, and again, it happened under both administrations, so we're not trying to point fingers at one or the other, but I would think that perhaps the methods they're using, and again, I'm hoping you might give us some insight, might be a little antiquated. The first thought that came to mind was during this last election, they could tell us the county, how many votes were in that county, how many people were standing online, and yet we have data that we all really rely on in our industries, and they are just way off. I'm betting the methods they're using a little antiquated.
Yeah, and I think the expectation that they would have data every month, it's a short time fuse. But what's interesting is there are a lot of private organizations, and I'm sure you're more familiar with them than I am, that provide similar data. And so there will be a check on whether the Bureau of Labor Statistics and the federal government in general is cooking the books. So that'll be interesting to watch.
So 3 weeks ago, we had a economist portfolio manager on from a fairly prominent research firm, and I asked him a similar question. And Howard, because my question for him was, You know what? Does it matter if it's 78,000 jobs or 128,000 jobs? Our country's so big. How does that even matter? But what he pointed out, it's not that number that matters, it's the trend that matters. You
Right.
know?
And the trends, and that's what I was trying to say
Yeah.
before, are the certain trend is assumed. And when the trends change, that's when you have to get huge restatements. And I think that's what they claimed happened in the last few months.
So Howard, I apologize. I want to come back to a prior point you made, and that was this idea that tariffs and inflation, there's a lag between the start and maybe when we actually see it. Chairman Powell actually brought that up in his speech on Friday in Jackson Hole, that it might be a couple of months before we actually start to see the tariffs show up in the data, even though I think you brought up we're starting to see the beginnings of it right now. So do you buy into this idea that it might take 3-6 months before we see real tariff cost increase in being passed on to the consumer?
Oh, absolutely. This increase in tariffs is unprecedented, at least in the last 100 years. So it's really hard to say how long it's going to take to filter through to consumers. I think that 0.9% increase last month in the producer price index is a real red flag. I think that's a sign that a serious increase is coming. It's not like these extremely minor. Inflation is in the high twos. I don't think that's the effect of the tariffs. I think the effect of the tariffs is going to be a bit higher. And I think you're going to see that as the higher prices wholesalers are paying gets pushed onto consumers.
Howard, we have about 5 minutes left, and I don't want this show to end without talking about another sea change in the economy that you bring up, and that's digital currency, whether you call it Bitcoin or crypto. Could we spend a few minutes kind of getting your
Sure.
take on that?
Yes. I view it as digital gold. And in the book, all the talk about the blockchain technology and the algorithm, I say that's as important to understanding Bitcoin as understanding how the printer gets the ink on a $20 bill. It's not relevant. Forget about it. To understand the economic impact of Bitcoin, forget about all the technology. What is Bitcoin and what does it do? It's a totally made up currency. And I'll go out on a limb and add, like the US dollar, it's a fiat currency. It's just made up. The difference is the US dollar, we know who made it up. We know the rules they operate under. We know who they are. Bitcoin, on the other hand, we don't know who made it up. We don't know the rules. I know people think they know the rules, but if for some reason the number of Bitcoin double tomorrow, who are you going to sue? Who are you going to complain to? There's no 800 number. In any event, so Bitcoin, I look at it as digital gold. Gold is probably more secure in that it can't be hacked, and it can't be it can't have the algorithm undermined. I think I'm not an expert in technology, but I have to believe that most technologies have flaws, and I think we may find some flaws with the technology underlying some of these virtual currencies. But it's, for all intents and purposes, I think it's easiest to look at Bitcoin and the other virtual currencies as digital gold. And the price has really been bid up. So it's fascinating to watch.
Howard, unfortunately, we got to cut the conversation short, and I think we're going to try to have you back. But
Great,
for
I'd love that.
now, how do people buy your book? Where can we find your book?
It's available pretty much wherever books are sold. Certainly on Amazon. We were talking about monopolies; they certainly have it. But most online booksellers sell it, and if it's not at your local bookstore, please ask for it. It's at most local bookstores.
And do you have a website where they can buy it as
Sure.
well?
I have a website. It's my name, HOWARDYARUSS.com. So you could certainly find it there.
And one last time, the name of the book is Understandable Economics, because understanding our economy is easier than you think and more important than you know. And we really appreciate your time this evening.
I really appreciate being here. It was great.
Howard, I hope we get you back. There are a lot of questions on your list, and we get them from clients all the time. So we love the common sense answers you give us. So hopefully we get you back.
Yeah,
Great. I hope so too.
we do this podcast for exactly to have the opportunity to speak to folks like you. So again, thank you very much.
Thank you.
Have a good night, everybody. We'll be
You
back
too.
next week with a new edition of the Lebenthal Report.